You know that feeling when a $150,000 progress draw hits your checking account and suddenly you feel like you're Warren Buffett's long lost cousin? Well, I'm about to ruin that feeling for you because that fat bank balance is lying to your face. I'm Wade Carper, CPA and author of Profit First for Commercial Construction. And today we're talking about one of the sneakiest cash killers in the construction business: lump sum deposits. These big checks show up looking all impressive, making you feel flush right when Thursday payroll has you sweating bullets. But here's the truth: most of that money is already spoken for, and treating it like found money is how good contractors go broke with full bank accounts. Picture this scenario. It's Tuesday morning. Your biggest client just wired $250,000 for materials and mobilization on that new hospital wing project. Your checking account balance makes you smile for the first time in weeks. Thursday payroll, cover. Those three subs calling for their draws, no problem. In fact, you're feeling so good that you approve a new excavator lease and decide to hire two more carpenters. Fast forward 2 weeks. The steel supplier is on the phone, demanding their $85,000 payment for pre-ordered materials. Your concrete crew wants a $30,000 progress payment, and suddenly that balance feels like smoke in a high wind. Let me break down specific ways these deposits deceive you and why your standard accounting setup makes the problem worse. Here's something your banker won't tell you. When a homeowner hands you $75,000 to pre-buy custom windows, that money isn't income yet. It's a liability. You're legally obligated to deliver those windows or return the cash. Spending deposit money on overhead is like using escrow funds to buy a new truck. It works great until it doesn't, and then it spirals into project cash crises and potential legal exposure faster than you can say mechanics lien. In Profit First for Construction, we treat these deposits differently than earned revenue because they are different. They're someone else's money temporarily parked in your account, like borrowed overalls. Looks like yours, but it belongs to somebody else. Here's the pattern I've seen 1,000 times. Deposits tend to arrive right when weekly payroll pressure hits. It's Murphy's Law for contractors. Your fattest check shows up when you're at your most vulnerable. Your bank balance doubles overnight, and your brain whispers, "We're doing great. Go ahead and hire those extra guys. Cover that equipment payment. You'll sort it out next week." This is classic bank balance decision making, and it's killed more construction cash flow than bad weather and change orders combined. Let me give you some back of the napkin math here. Say you got $50,000 in the bank on Wednesday, and Thursday payroll is $45,000. You're sweating. Then a $200,000 progress draw hits Wednesday afternoon. Suddenly, you got $250,000 in the account, and that payroll looks like pocket change. But here's the reality. Of that $200,000 draw, maybe $180,000 is already earmarked for subs, materials, and labor. You've really only got $20,000 of flex cash, but your checking account shows $250,000, and your brain starts making decisions based on that inflated number. Without dedicated job expense tracking, that $300,000 progress draw masks whether you're actually hitting target margins. When direct job costs, your subs, materials, field labor, permits, all get mixed up with overhead expenses in your general checking account, profitable jobs look the same as losing jobs. Let's say you think you're hitting a 25% gross margin on a commercial renovation. But because everything flows through one checking account, you don't realize that project is actually running at 8% gross margin, or worse, negative. The cash keeps flowing from draws, so it feels profitable, but you're actually bleeding money on that job, and you won't know until December when your CPA delivers the bad news. Here's a riddle for you. When is $100,000 not really $100,000? When part of it is retainage that won't be released until the job's done and the owner's satisfied. Most commercial contracts withhold 5% to 10% of each progress draw until project completion and punch list resolution. So that $100,000 draw, 10%, $10,000, is sitting there in your bank balance looking all pretty, but it's unearned and unavailable until the end of the job. Spending retainage now is like eating your seed corn.
Feels good today, but you'll be mighty hungry come harvest. Late in the project, when you need that money for final costs and warranty work, you discover it was spent 6 months ago on overhead that had nothing to do with the job.
This one's subtle but deadly. A big deposit on the luxury custom home project accidentally funds cost overruns on the struggling commercial renovation. Both projects look adequately funded until the custom home's material bills arrive and the commercial job hits its retainage release milestone.
Suddenly, neither job has proper cash reserves, and you're robbing Peter to pay Paul while both of them are getting mighty irritated. This is cross-job contamination, and it's like spreading a cold through your whole crew. One sick project infects all the others.
So, how do we fix this? Profit First for Construction uses 5 specific structural guardrails that convert these deceptive lump sums into disciplined cash flow. Think of it as building financial scaffolding that prevents dangerous falls. Every dollar of customer prepayment gets parked in a separate bank account, or at minimum, clearly labeled ledger account that's designed for deposits only. This isn't your operating account. This is like a trust fund for customer money.
When that $150,000 mobilization payment hits, it goes straight into isolation. You're preserving those funds for their intended purpose while keeping temptation out of your daily checking account balance. Can't spend what you can't see.
This is the game changer. In Profit First for Construction, we separate job expenses from operating expenses. All direct job costs flow through a dedicated JobEx account. Subpayments, material purchases, field labor, equipment rentals, permits, bonds, insurance.
Instead of mixing your $50,000 in subpayments with your $8,000 office rent in one general checking account, JobEx isolates job costs. Now you can see whether that profitable job is actually hitting your target 25% gross margin or bleeding you dry at 8%. This separation forces visibility. It's like turning on the lights in a dark room. Suddenly, you can see exactly where the money's going and whether each job is pulling its weight. Retainage gets its own separate account. Period. On that $200,000 progress draw with 10% retainage, $20,000 goes directly and immediately to the retainage reserve account. No temptation, no surprises, no late project cash shock when you realize how much of that balance was never actually yours to spend. If you can't collect it today, don't spend it today. Simple as that.
Traditional Profit First allocates on the 10th and 25th of each month. That's fine for a lot of businesses, but construction operates on weekly payroll cycles and irregular draw schedules. We need a different rhythm. Profit First for Construction allocates weekly or biweekly, right in sync with your payroll and draw cycle. Frequent, predictable allocations mean a single large deposit won't trigger a spending spree. You're taking small, regular sips instead of gorging on Sunday after fasting all week. Your financial digestion stays steady. Here's some front porch wisdom that'll save your bacon. Keep your profit and tax account at different banks than your operating and payroll accounts.
Why? Because construction's weekly payroll pressure is real. When Thursday morning rolls around and you need $50,000 for labor, and that fat checking account is staring you in the face with profit and tax sitting right there in the same online banking portal, temptation is real. Moving profit and tax out of sight, literally to a different bank, is like hiding the cookie jar on the top shelf. You can still get to it if you really need to, but it requires enough effort to make you think twice. That friction has saved more contractors than any spreadsheet formula ever could.
Let me walk you through exactly how to handle these deposits when they hit, step by step. That customer deposit for long lead materials doesn't get to sit pretty in your operating account like a cat in a sunny window. All receipts land in your income account first. That's the front door where all money enters. The same day, immediately, you move prepayments to the job deposits liability account.
Never leave customer prepayment money in OpEx or general checking where it inflates your spending sense. Segregate it now, protect it always.
Time to buy those special windows or that custom millwork. Release exactly what you need from the job deposits liability account into your JobEx account. pay the vendor, and keep the paper trail cleaner than your grandmother's kitchen.
If you got a $75,000 deposit for materials and you're ordering $45,000 in custom cabinets, you move exactly $45,000 from deposits to JobEx, then to the vendor. The leftover $30,000 stays protected in the deposits account until the next approved purchase.
This is where the magic happens. When that progress draw hits, you split it like dividing up Sunday dinner.
Retainage portion goes immediately to the Retainage reserve account. Current job costs go to JobEx for this cycle's subs, materials, and field labor that are due now. Allocate the rest according to your PFCC rhythm. Profit goes to the separate bank, tax goes to the separate bank, owner's comp gets allocated, and OpEx gets its share. Let me show you some quick napkin math. Say you get a $200,000 progress draw. 10% retainage, $20,000, goes to Retainage reserve. Current job bills, $120,000 for subs and materials due this cycle, go to JobEx. That leaves $60,000 for allocation. Using basic PFCC percentages, 5% profit, $3,000, 15% tax, $9,000, 50% owner's comp, $30,000, 30% OpEx, $18,000. You're not making decisions based on that $200,000 showing up. You're making decisions based on the $60,000 that's actually available for allocation after obligations are covered.
Let me give you 4 red flags that tell you you're being hoodwinked by your own money. You add staff or buy equipment immediately after a big check without confirming an 8-week payroll surplus in your payroll account. That's not strategic growth. That's bank balance decision-making disguised as confidence. You borrow from job funds to cover overhead shortfalls just this once, expecting the next week's draw to replenish it. Famous last words. That just this once turns into every week, and suddenly you're running a Ponzi scheme with your own projects. Your profit and tax accounts live at the same bank as your operating account, and you regularly raid them for payroll gaps. If it's that easy to move money, you will move it, especially at 7 a.m. on Thursday when payroll's due and your coffee hasn't kicked in yet. You're regularly shocked by cash tightness late in projects when retainage should be releasing. If that surprises you every single time, it means you've been spending money that was never actually earned yet. Let me give you a simple standard operating procedure. 6 steps that any project manager can verify and any bookkeeper can execute.
Intake. All money lands in the income account first. That's the front door. Everybody comes through it. No exceptions. Segregate liabilities immediately. Same day the money hits, customer prepayments go to job deposits, liability account. Retainage portions go to Retainage reserve account. Fund current commitments. This cycle's direct job costs move from income to JobEx. Subs due this week, materials ordered and delivered, field labor earned, permits pulled, those go to JobEx now. Allocate by rhythm on your set cadence, weekly or biweekly. Allocate from what's actually available, not from deposits held for future obligations, to profit tax at the separate bank, owner's comp, and OpEx, according to your PFCC targets. Track long lead purchases. Release deposits to JobEx only when items are actually ordered. Maintain clear audit trails so you can show the customer exactly where their deposit money went if they ever ask. Project level clarity. For large jobs, anything over, say, $500,000, consider using project-specific sub-accounts. Isolate deposits, cash flows, and retainage by individual job. This eliminates cross-job contamination and makes reporting to owners and lenders dead simple.
Here's the bottom line. PFCC's deposit handling converts deceptive lump sums into disciplined cash flow. By treating prepayments as liabilities with escrow-like discipline, not lottery winnings, you stop fooling yourself with inflated bank balances. By forcing all direct jobs through the JobEx account, you see whether each job actually makes some money. By isolating retainage and timing profit distributions appropriately, you avoid spending earnings you haven't fully earned yet. Look, I get it. This feels like a lot of structure for something that should be simple. But the truth is, construction cash flow isn't simple. You're dealing with lumpy revenue, weekly payroll pressure, progress billing, retainage, long lead materials, and jobs that span months or years. Your money behavior needs structure that matches the complexity of your business model. If you want the full system, including the exact account percentages, the allocation formulas, and how to adapt all this to your specific business size and trade, grab a copy of Profit First for Commercial Construction on Amazon. I walk you through the entire implementation step by step with real contractor examples and troubleshooting for every but what about question you're thinking about right now. Or if you want hands-on help implementing this in your business, head over to profitfirstconstruction.com and schedule a call with our team today.